Thanks for joining us today. We're here to talk about Nice Apartments in Whitestown, Indiana. This is the fourth property in Fund 4. But before we get started, got to do a little housekeeping. So before you do any investments, please make sure you download our offering memorandum, you get the PPM and the operating agreement, and you talk to any of your trusted advisors. And to our 250 plus investors who are already in Fund 4, thanks for being a partner with us. Excited to show you this asset. And for those that are not yet investors, please feel free to reach out to us. And remember, we can work with your investment advisors. We're on the Charles Schwab platform, the SEI platform. We're on Advanta, Madison Trust. So we've got a lot of ways we can help you. But again, reach out to us. Love to chat with you about it. So for those that have not met me, I'm Ben Cotton, Vice President of Investor Relations with BAM Capital. I've been in business development in some form or another for the last 20 years. And with multifamily, I've been part of probably $4 billion in transactions and probably almost over $1 billion now in raised capital from investors, be it through debt or equity. And I'm joined with Ryan Three. So Ryan, please introduce yourself.
Yeah, I'm a Vice President of Asset Management here at BAM. Been with the company for 10 years now. Started out in the property management side of the business and then transitioned over to asset management acquisitions about midway through that stint, and been involved in pushing $1 billion in transaction volume between acquisitions, dispositions, financing, refinancing, recapitalizations with the company.
Sure.
And currently oversee asset management and for our $900 million portfolio of beautiful apartment assets across the Midwest.
So before we jump into the asset, let's just do a quick overview for those that don't know us. So BAM Capital started about 15 years ago, literally with one apartment. And fast forward to today, we have over 6,000 units. We've done over $1 billion in transactions, returned nearly $200 million to investors. And if you look at our track record, remember, the past isn't necessarily an indication of the future, but if you look at our track record, which is audited, if you invested $1,000 with us, on average, last 12 exits, we would have returned back to you about $2,580, and that's over a 3.5 year period. So what we are is operators. We're not speculators. We're not developers. We don't do student housing. We don't do subsidized housing. We don't do trailer parks. We don't do storage. We do great properties. When I say great properties, places you or I or any of you would live tomorrow if you moved to the suburbs of Indianapolis or Des Moines or Rogers, Bentonville, Arkansas area. So we buy great properties in great locations, and then we operate it with our people. We have over 125 employees. So when you go to the property and you meet the leasing agents, it's our people. When something breaks on the property, it's our people that do that. And we're really good at operating existing properties in great locations.
They're doing the fixing, not the breaking, just to be clear. But we have an amazing team, right. Amazing teams across 5 states, 22 assets. Really proud of the track record we've built, and all the credit goes to them for all their hard work.
Right, so let's get into this fourth asset.
Yeah, for sure. Nice Apartments. It's in Whitestown, Indiana, which is a suburb just northwest of Indianapolis, the capital city of Indiana. This asset just finished lease up a few months ago, so built in 2022. 204 units, which is a great size asset. Class A in every sense of the word. I mean, absolutely beautiful design and construction there. Board and batten siding and incredible masonry, and then this pool. I mean, it looks like a pool at a resort somewhere in Florida. But it's right here in central Indiana, and great unit sizes, just over 1,000 square feet. So to further get into it, we like this deal a lot for a multitude of reasons, but to sum it up into 3 where we see the upside, economies of scale. Ben, we've got 10 properties, about 2,000 units. within a 30-minute drive of this asset that is under our ownership and management. So we know Indianapolis, this is our hometown, our backyard, and we have a high level of belief that we can reduce operating expenses at Nease by as much as $1,000 a unit, which is almost $250,000 in NOI that we're picking up just on expense reduction alone. And this is with our amazing people, our amazing relationships within the industry, and our proven methods of operating these communities at a high level but very efficiently, that we can accomplish that. And then further, we see some rental upside here. Average trailing 6 months lease rent growth is 5.4%, which is really strong. The average rent growth in Indianapolis over the last 20 years has been 3%. And, excuse me, the wallet share of rent, Indianapolis is a very affordable place to live. And wallet share of rent is essentially the rental amount divided by the income the resident makes. That number in Indianapolis is in the low 20s, high teens. Here at Nease, it's 19%. In most other larger cities or even comparable metros, of Chicago, Atlanta, Charlotte, San Diego, that number is approaching 30 and 40%. So very, very affordable.
Yeah, no, listen, I want to make sure everybody understands what wallet share is. So it's really important. It's one of the metrics we look at. And so it's this idea that if you make $1,000, once you get to $300 or $350 of that, it becomes somewhat unattainable. You can't do the other things in your life. And so the idea that we've got, Flats of Fishers was even better than this, but you've got this property that's at 19%, so $190. There's a lot of room for rent growth. And just to talk about Nease for a second and our acquisition of it, I see a theme here. Actually, we know a theme in Fund 4, which is buying properties from developers. We've seen some motivated sellers in the development space because they're 3 to 4 years in, their investors may not have gotten any money, and they've got to recycle that capital to get to their next project. And so for us, it's an opportunity because typically developers are focused on leasing up, stabilizing, and getting out. And for us, we're really about, okay, where are expenses high? Where are there other sources of income? We're really about optimizing that property. And you get a chance to do that because the next generation of leases come in.
Exactly. Yes, exactly. They started their lease up in early 2022. So now we're starting to get into that second generation of leases. And so incredible opportunity to increase income. And then further, talking about the original developer, the developer, very reputable developer who is based in Indianapolis. They've built over a dozen communities like this across central Indiana and dozens more nationwide. So couldn't be happier to acquire a product such as Nease from this great group.
So besides people, which is what BAM cares about, and that's really the secret to our business. But outside of that, location is truly everything. Everybody hears the location, location, location. Maybe talk a little bit about this location.
Yeah, it absolutely rings true on Nease. So, Ben, I don't know if you've been to Whitestown, Indiana. I've lived in central Indiana my whole life. And Whitestown 10, 15 years ago was a truck stop exit. If you're on your way to Chicago, you needed to stop for gas or food or whatever, you stopped there.
Yep.
It's a little different story now. The population of Whitestown has grown 255% since 2010 and 8% just in the last 3 years. It's the fastest growing suburb in the entire state. And what's beautiful about Nease being on the Whitestown exit is that you have immediate access to Indianapolis and surrounding Indianapolis suburbs, white-collar employment hubs. You basically take 3 right turns out of Nease and you're on Interstate 65 South, either heading towards downtown Indy or heading towards Carmel, which is where we're sitting right now, Ben.
Right here, yeah.
Which is a huge hub for white-collar office employment. And also, if you take a left turn onto 65 and you're going north towards Chicago, you're on your way to Purdue University, West Lafayette, another 30, 45 minutes up the road. But on the way there, there's this thing called LEAP, which we'll get into in a couple of slides. But this is a huge economic development project, largest in the state's history, just about 15 minutes up the road from Nease. And then also, it's in one of the best, easily a top 5 school system in the state, Zionsville Community School District, A+ schools. People want to live where the good schools are.
Right, and this is a good point just to remind investors on our thesis. The things, or what I like to call our non-negotiables, which is population growth,
Yep.
job growth,
Yep.
safety and security,
Check.
and good schools.
Absolutely.
Got it.
So talking about Nice, it's an asset that the institutions would absolutely clamor for, Ben, if they weren't sitting on the sidelines right now.
No, that's a good point, and we get some questions about this. So one of the things that makes BAM unique, we have over 1,000 investors. Actually, we're closer to 1,100 now. We're growing rather rapidly. And that's what's allowed us to move forward. I mean, Ryan, you sit at the table 2 years ago. How many bidders would you have seen on a property like this?
Dozens.
Yeah.
And we would be in the fray, but
Yep.
we'd be getting outbid by these larger institutions. And we're able to acquire this asset, this beautiful institutional quality asset, at an incredible basis because these institutions don't want to get involved right now.
Right. So there's a real difference between what I'll call financial speculators and operators. We're operators. And so financial speculators, you'll see if you ever compare, they'll take more leverage. So we'll get into the debt later. I don't want to get too much into it, but you'll see them. They'll take as much money as they can from debt. So maybe if it's a $100 million property, they may take $85 million in debt. You won't see us doing that, especially right now with where rates are. So what's really nice is Ryan's team is seeing less competition for purchasing than they have in the past. And it's a real opportunity. It's why we've been so active in buying 4 properties now in just under 12 months.
And it underscores how we've returned to buying in Indianapolis. We weren't doing that 18, 24 months ago because, again, like we mentioned, all these institutions, it becomes a huge pricing bidding war, and now that's completely gone, and now we're one of a handful of groups that are serious and able to go after these great assets and acquire them at a fantastic basis.
No, that's great. And then maybe just talk real quick about the demographics in the market. A couple little things, and we'll go to the next slide.
Yeah, so we talked about population growth, very affluent submarket, median household incomes just north of $100,000 a year, and the job growth's incredible too. 41.9% projected job growth in the next decade just in Boone County alone, which is the submarket that Whitestown and Nice are on.
Very good. So financial overview. I'll let you take some of this if you don't mind.
Let's talk some debt, Ben.
Yeah,
you know I love to talk about debt. So we're looking at taking out a $34,715,000 loan to acquire the property at a 68% loan to value, which is very prudent. Anything below 70 is good. And it's going to be a floating rate loan. It's going to have a 275 spread over SOFR. And we also have the opportunity to purchase a rate cap not sooner than 18 months into the project. So what that means is right now we're escrowing to potentially acquire a rate cap a year and a half into this project. That's going to essentially fix our, I don't want to say fix, but more or less our theoretical interest rate at that point will be not more than 6.60% with the estimated strike rate of 3.85. That means SOFR the highest SOFR can, or the lowest SOFR could be within that rate cap is 3.85%. Now the floating rate, with that we get prepayment flexibility. Essentially we can refinance or sell with little to, I don't want to say no penalty, but a lot lower penalty than we could if we went into this deal with a Fannie or a Freddie permanent loan for 7, 10, 12 years where we'd have a yield maintenance or defeasance prepayment penalty that would absolutely hurt exiting this asset and an attractive return to our investors. So the prepayment flexibility after 3 years, we essentially pay 1%, which is pretty nominal in the grand scheme of this asset, that if it makes sense to sell or to refinance, depending on market conditions, we can do that.
So I want to remind everybody, because we get a lot of questions about this, like why aren't you using fixed debt? And this is an important differentiator that I think sets us apart from most of the groups out there. We've got an amazing relationship with Merchants Capital.
Yeah.
I mean, it's amazing. And because of that, we've created some products that are almost exclusive to us that allow us to essentially fix the debt, but have the flexibility to monetize it. So if we want to refinance 2 years from now because we've popped, the net operating income is increased 50%. We've got an ability to do. We can do that without getting prepayment penalty. If we want to sell it 3 or 4 years from now, we can do that. But we've got controls in place through escrowed cash and and caps.
Yeah.
To essentially sleep at night, right? Because we're trying to build a business that's about excellent returns for our investors, but we don't want to blow up, right? We want this business to outlast you and I and everybody else.
For sure, Ben. Yeah. And again, can't underscore the relationship with merchants enough. Something Ivan said, absolutely true. They are our biggest investor, literally, and they're just a fantastic relationship. And for them they really understand not only our business model, but they also understand how we do things, and they trust us, and they're able to really work with us. And there are a lot of operators that are good, but don't have quite the relationship with a lender or lenders that we do with merchants. That it's hard for them to go and find great opportunities such as Nice right now.
The next thing, obviously, we want to talk a little bit about the strategy. So for a reminder for all of our investors and those who might invest with us, business operators, we look to increase the bottom line. We call it net operating income. If you're a business owner, it might be your EBITDA, but that's what we do. We look to increase it through controlling expenses, being great at customer service, looking for other sources of income. And then the final thing is we do see some rent increases. So maybe just talk a little bit about that, that pro forma.
Yeah, so just looking at the effective gross income, we talked earlier about 5% rent growth being realized right now in new leases. We're underwriting 3-4%, just conservative.
Right.
But right now in our portfolio as a whole, we're achieving 10% lease trade outs on new leases and renewals in the last 3 months, and even looking to new leases forthcoming. So. Yep. Again, conservative underwriting, but incredibly outperforming. Again, it's a testament to our teams on the ground that do such a great job taking care of these assets. And then ancillary income. We're not hanging our hats just on being able to push rents, but also we're able to really optimize and increase ancillary income through a variety of means and just our proven methods of operating these assets over the years. And then operating expenses, again, we talked a little bit about that earlier. Mm-hmm. Our people on the ground, our relationships within the industry that are able to help us really run these assets at a high level, taking care of our residents, but also doing so in a very efficient manner.
Yeah.
And again, we increase NOI, we're increasing the value of property. As simple as that, Ben.
No, and then that drives returns, which is obviously very near and dear to all of our investors' hearts. So we're a multiple-driven business. Our goal is to give you a 2 to 2.25x on your invested capital. That's our goal. And if we do it in 3.5 years, as we have traditionally, that equates to like a 35% IRR. If we do it in 5 years, it's going to be in the 20s. And if it takes us 7, it's still going to be just shy of a 20% IRR. But the idea is, on average, we look to double your investment in a 3 to 5 year period, and we do it by being really great operators of great properties and great locations. Market.
So yeah, let's talk about where Whitestown is relative to the grand scheme of Indianapolis. So it's, again, just northwest of Indianapolis off Interstate 65. Again, very high growth corridor, but still very easy access to Carmel, to the northwest side of Indianapolis, where there's a large medical hub. You've got Zionsville, great residential area. Again, one of the best school systems in the entire state. And you can also be in downtown Indianapolis in under 15 minutes. And then just talking about Boone County as the sub-market that we're within with Whitestown and Nice, median household income $103,000, which is really, really strong. and a median home value of 326,000. So very connected, rapidly growing, and just very desirable place to live.
It's before you go to the next one, just so we talk about that 326. It's important to realize a year ago, that $326,000 home was probably like $275,000 or $250,000, and you could get a mortgage on that property at 3.5%, 4.5%. Today, that same property is an 8% mortgage. We tend to compete with folks going to those types of houses, and their monthly expense for those has gone up, in some cases, 75+%.
Well, and we had it on an earlier slide. We might have actually glazed over it, but renting at Nice, based on looking at wallet share rent, renting at Nice is 1.7 times more affordable than owning a home.
There you go.
So, there you have it. Now let's talk about JOBs, jobs. So major employers. So the LEAP Innovation Park. This is an absolutely incredible, unprecedented project the state of Indiana is taking on in terms of economic development. So it's the largest economic development project they've ever done, and also it's going to be anchored by Eli Lilly. I think you've probably heard of them, Ben. They're kind of a big deal locally. They've been headquartered in central Indiana for 150 plus years now. This is their largest investment they've ever made, a $3.7 billion pharmaceutical complex that they're going to be building in the LEAP. LEAP stands for Limitless Exploration Advanced Pace. Essentially, it's going to be a 9,000-acre complex that's got life sciences companies, it's got advanced manufacturing, and other industries that pay pretty good money to the people that work for those. And companies always want to invest where the talent is. Yep. And the talent wants to live where the good schools and the good retail. So if you sense a theme here, Ben, this is a good little area to be in, in the northwest suburbs of Indianapolis. So further, you've got, I mentioned, 15, 20 minutes from Carmel where we're located. You've got amazing, diverse white-collar employment and insurance, financial services, airlines, banking, HR, IT, so many high-paying jobs in that corridor alone, and maybe you might have a household where one person works in Carmel, other might work in Lebanon or at the LEAP, or maybe someone's working up in West Lafayette at Purdue, which is 30, 45 minutes away, depending on where you're at in that area. So just, again, an incredible proximity to very diverse employment and talent. And then to highlight just Boone County alone, again, this county just northwest of Indianapolis, it's got really strong employment. Looking at this graph over here above Ben, going into pre-COVID, unemployment in Boone County was 2.7%, and now after COVID, it's at 2.1. So that just shows, again, the job growth that we're experiencing. We're looking at 2.4% job growth year over year. And again, we mentioned it earlier, 41.9% job growth in the next 10 years, which exceeds the national average in that span of 33%.
So one thing we didn't cover, and we get this question a lot, is supply. Yeah. So supply and demand. So what supply is coming online? So maybe you can just talk a little bit about that when it comes to our markets.
Yeah, so if one way to look at supply and demand, because there's a lot of press, there's all these apartments coming online, there's going to be this wave of supply, and these multifamily operators aren't going to know what to do.
Phoenix, Austin,
Yeah, and if you look at a Phoenix or one good way to look at it is the percentage of units under construction relative to the total apartment supply in that market.
Right.
For Phoenix, right now that number is 13%.
Okay.
In Austin, it's 15%.
Yeah.
Charlotte's 15%, Austin's 12%, so low teens.
Yep.
But if we're looking at three of the biggest MSAs that we're in right now, Indianapolis, Des Moines, Northwest Arkansas, it's in that 4% range. Indianapolis, 4.4%, Des Moines, 3.6%, Northwest Arkansas, 4%.
Yep.
So that, again, that's a pretty big disparity. And another way to look at that metric is, now you got to understand that supply is going to be absorbed on some level. Sure. But if let's just say the average occupancy in Phoenix right now is 90%.
Right.
And you take 13% away from that, the occupancy, theoretically, assuming nothing gets absorbed, which it will, that occupancy is going to go down to what, 77%?
Right.
Which, again, if you're below 80%, you're not breaking even right now.
Right.
But again, some of that's going to be absorbed. Whereas Indianapolis, we're looking at, in Des Moines and those other, Northwest Arkansas, we're looking at 93, 94% occupancy in that market and only 3-4% supply growth. And again, supply is outstripping, other way around, demand is outstripping supply
Right.
in these markets, and especially in the sub-markets where people want to live. The good schools, the good jobs, the good amenities, the good retail.
Right. Ryan, one of the other questions we get, and I know we've added 4 properties in less than a year, but it's a fair question. When's our next acquisition?
We're working on it, Ben. We're always working on it, but we're still, at the same time, very, very disciplined. We look at, I kid you not, hundreds of properties a year.
Right.
And all over the Midwest, all like Nease in some way. Good fundamentals. We mentioned schools, jobs, population growth, all that. But it's got to be a deal. It's got to pencil. It's got to deliver strong returns to our investors like we have in the past. So we're keeping that discipline. That's absolutely sacred to us. But we're always looking, Ben.
Yeah, and when you say pencil, just so I'll hit a fine point on this. He says, what we mean by pencil is if we buy a property, we've got to have a high conviction with our people and our processes that we can significantly increase the operating income of that property. If we can't do it, it's not of interest to us. And by the way, it has to be all those non-negotiables. Great location, safety, schools, all the things we talk about.
Yes, absolutely.
Yeah.
So Ben, how do I invest? I mean, I'm already sold. This is a great asset and a great opportunity.
Yeah.
How do we get in on this?
No, so reach out to us. So on the screen you can see our contact information, and you can certainly go to our website, download the offering memorandum. And by the way, keep in mind, we can work with your qualified accounts. So IRAs, Roth IRAs, and we can work with your investment advisor. We've got quite a few that work with us in that 1,100 investors that we have. So listen, really appreciate your time today, and the
pleasure.
folks that have tuned in to listen to this. Please feel free to reach out, and we'd love to help you in any way we can.